everyone, welcome back to our channel and welcome back to this video. In this video, we're going to focus on how the AI disruption is reshaping the enterprise software. And within this, we're going to focus on 4 key points. First and foremost, the SaaS repricing. We're going to see how the enterprise software valuations have collapsed 70 to 85% from 2021 peaks as the markets are reassessing growth assumptions against AI disruption risk. Secondly, we are going to look into the dual threat factor, wherein we are seeing AI challenging SaaS on 2 fronts. First, as a substitute for existing tools, that is, clients building internally, and secondly, as a demand destroyer, wherein fewer knowledge workers means fewer seats. Thirdly, the sector response, wherein we are seeing the leading players cutting the headcount, replacing technical leadership with AI-focused executives, and racing to embed generative capabilities into the core products. And then we'll wrap up with the investment thesis, wherein we are seeing differentiation emerging between the companies that successfully integrate AI as a value multiplier versus those facing commoditization of the core functionality. With this, let's do a deep dive. Let's start with the great SaaS repricing. The enterprise software has entered a valuation regime change. The sector that commanded premium multiples throughout the 2010s and reached euphoric peaks during the pandemic-era digitalization wave now faces a fundamental reassessment. The market participants are no longer pricing SaaS companies primarily on the revenue growth trajectories. They are discounting for existential risk. The repricing has been severe. Names that commanded 30 to 50x revenue multiples in 2021 now trade at 5 to 10x, and the compression reflects more than cyclical normalization or interest rate sensitivity. Investors are actively modeling scenarios wherein generative AI either replaces the existing software tools entirely or commoditizes functionality that once justified the premium pricing. And this is not limited to speculative growth names. The established players with profitable operations, strong retention metrics, and diversified customer bases have seen similar multiple compression. The market is pricing in structural, not cyclical uncertainty. Next, let's focus on the dual disruption vectors that are emerging. AI presents 2 distinct but reinforcing challenges to the enterprise software business model. Understanding both is essential for assessing which companies can adapt and which face genuine existential pressure. The first vector is AI as a substitute. Large language models and AI coding assistants enable organizations to build custom tools internally at a fraction of the previous cost. Tasks that once required purchasing specialized SaaS solutions, workflow automation, document processing, data transformation, basic analytics, can increasingly be handled by internal teams using AI-augmented development. What we are seeing is that the build versus buy calculus has shifted materially. The second vector is the demand destruction. If the AI-driven productivity gains translate into smaller knowledge workforces, the total addressable market for per-seat software licensing also contracts. The collaboration tools, the project management platforms, and productivity suites all price on user counts. Fewer employees means fewer seats, and this creates a potential negative feedback loop wherein same AI capabilities that threaten substitution also shrink the customer base. The interplay between these vectors is what makes the current disruption particularly challenging to navigate. Companies must simultaneously defend against displacement while their addressable market may be contracting. Next, let's look at the industry response. The software companies are responding with a combination of cost discipline and strategic repositioning. Several patterns have emerged across the sector. First and foremost is the headcount rationalization. Companies are reducing staff even while reporting revenue growth, prioritizing margin improvement over expansion. AI is being cited as enabling efficiency gains that justify smaller teams. Secondly, what we are also seeing is leadership restructuring. Technical leadership is being refreshed with executives who have demonstrated AI expertise. The Chief Technical Officer and the Chief Product Officer roles are increasingly filled by candidates with machine learning backgrounds. Thirdly, you have product integration, wherein we are seeing embedded AI features are being rushed to the market, positioning existing tools as AI augmented rather than AI replaceable. The race to become an AI platform rather than AI casualty. Lastly, we are also seeing pricing model experimentation. Some vendors are exploring outcome-based or usage-based pricing to reduce exposure to per-seat contraction risk. To understand this in depth, let's look at a case study. Let's look at Atlassian's adoption challenge. Now, Atlassian exemplifies the pressures facing the established SaaS players. The Australian company, which makes many famous collaboration tools like Trello and Confluence, has seen its market capitalization decline from approximately 116 billion to 20 billion over the 5 years. And this is amongst the sharpest contractions that we have seen of any major software name. Now, the compression occurred despite operational performance that would have been celebrated in prior eras. Revenue growth exceeded 20% annually and 5 million customers on its AI product offerings. Markets are looking past the current results into the structural risk. The management has responded with measures that mirror the broader industry playbook. The company has reduced headcount by 10%, replaced its chief technology officer, elevated executives with AI expertise, and paused hiring outside of AI and enterprise sales divisions. These moves acknowledge that the competitive bar has shifted. This particular case is instructive because it illustrates how quickly the market sentiment can turn even against category leaders. The company's products are deeply embedded in enterprise workflows, and switching costs are real. Yet, the investors are pricing in scenarios wherein the embeddedness erodes, either through AI-enabled alternatives or workflow contractions that reduce the seat demand. So, what are the investment implications of all this? For the capital allocators, the SaaS repricing creates both risk and opportunity. The key analytical questions center on which companies can successfully transition from the AI threatened to AI enhanced, and which face genuine obsolescence risk. The defensible positions in this sector are characterized by proprietary data modes that improve AI integration, workflow embeddedness that increases rather than decreases with automation, network effects that AI tools amplify rather than displace, and pricing models resilient to headcount reduction. The vulnerable positions in this sector include commodity functionality that is easily replicated by the general purpose AI tools, pure per seat pricing exposure, limited proprietary data assets, and products positioned as standalone utilities rather than platform infrastructure. The valuation multiples remain compressed across the sector, but dispersion is likely to emerge as AI integration results become visible. What is expected is that companies that demonstrate AI as margin accretive and retention positive will likely re-rate, and those wherein AI accelerates commoditization will face continued pressure. Let's wrap up this video with what to watch out for. First and foremost, the AI feature adoption matrix. Companies disclosing specific usage data for AI-enhanced features provide insight into whether integration is driving value or merely checking a box. Secondly, the net revenue retention trends. The contraction in net revenue retention would signal that AI substitution risk is materializing in customer behavior and not just investor sentiment. Thirdly, the pricing model evolution. Shifting from per seat to consumption or outcome-based pricing indicate management conviction that headcount-based models face structural pressure. And lastly, the enterprise versus the SMB divergence. Large enterprises with complex requirements may prove more defensible rather than SMB segments wherein AI tools can more easily substitute. Now that's what we wanted to share with you with respect to AI disruption reshaping the enterprise software. Hope you've enjoyed the update. Stay tuned in for our next one.